Hey everyone, and welcome to another edition of the Buddy Study Group. And today we're going to take a bit of a dive into the short-term care market. And Rhonda is here to join us, who is a wealth of knowledge in this area and very experienced in working with short-term care products. So the plan today is not to talk just about product, but also for many of you, a refresher. For those of you who are new, this will be very valuable. How to really place and position short-term care products, where they're best used, and maybe a little talk if we have time on where we see the market going. So Rhonda, I really appreciate you being here as you have been a million times over, and you can take it away whenever you're ready.
All right, sounds good. Well, welcome everybody. Hopefully everybody will take away a couple nuggets today from short-term care planning. I'm glad to see that we have some new faces on because I was thinking, oh my gosh, what am I going to say today that I haven't already said before about short-term care? So hopefully we have some new faces. They'll have some good takeaways. So first of all and foremost, I always like to preface that we are long-term care specialists. I'm a long-term care specialist. I believe in long-term care planning. And typically the definition of long-term federally IRS wise is 2 years or greater of coverage. So we would love to get all of our clients, particularly females, 3, 4, 5 years of benefits, and even some males that may have, dad and grandpa had a history of dementia, Alzheimer's, or strokes, where they want longer benefits. But the reality is, we all know that some people have health issues that simply do not qualify for long-term care. And some people financially do not have the wealth to be able to afford a premium for a long-term care policy. So what's great about our industry today versus 30 years ago is we have so many different products. I get a little frustrated when you hear people saying, oh, the long-term care industry is dried up. We don't have any products. Well, we don't have nearly as many traditional products as we did 30 years ago, but we do have a lot of different strategies. And that's one thing that you keep hearing that Buddy is bringing to you with the different strategies that they can offer here. So today we're going to dive in a little bit about the short-term care strategies. Now, short-term care, to me, it resembles a traditional long-term care where it can be comprehensive. So it can cover home care, it can cover facility care, they can have inflation built into them, but it's called short-term care because it's limited to 1 year maximum of coverage. Now, here's what's unique about short-term care. We're used to long-term care where it has one big pool of money that you can use, intermittently for home care, adult daycare, hospice, community care, facility care, you name it, but you get this one big pool of money and all the money comes out of it. Short-term care, we actually divide it up. So you have a separate pool specifically for home health care, and you have a separate pool specifically for facility. So they break it up. You have two pools, and you can have a maximum of 1 year. Every company's a little different, but typically I think it reads 360 days in a facility and maybe 360 days of home care or 52 weeks of home care. Okay. So that's why we call it short-term care, because we're going to be limited to 1 year of each. Now, what I love about the short-term care products is they offer a 0-day elimination period, and that is awesome, particularly if you have clients that simply do not have the wealth. If they can't afford the premiums, they may not have enough assets, checking, savings, reserve, so that sometimes they don't even have the money to pay in 90 days out of pocket. So if you've got some clients that, simply don't have, $100,000 in non-qualified savings, how are they going to come up with the premium for a traditional or a hybrid long-term care product? Let alone where are they going to get the resources to come up with that 90-day deductible? For some people, it's just purely a hardship. So the nice thing with the short-term care is they have those 0-day elimination periods. That means they get access to home care on day one, and they can have access to facility care on day one. And I will tell you that is a really great feature, and it's great to be able to talk and share that with your prospects. Okay. The other nice thing about the short-term care is they're typically cash indemnity plans, where you get a check every month, and it does not deter you from applying for Medicaid. Okay, so we're talking about Medicaid, Title 19, not Medicare healthcare. So what happens when you have a client that may have, again, may not have a lot of wealth, finances are tough, and they simply only have, maybe they own a home and it's a modest home, maybe it's $100,000 to $150,000 home, and maybe they only have $40,000 in savings, or maybe they're renting an apartment. We know that it's simply not going to take long at $10,000 on average a month for them to spend down and qualify for Medicaid, right? So are we really doing our best interest to come up with a premium for a traditional long-term care when they may not be able to afford the premium and they really don't have the money for to cover the elimination period? So with the short-term care, one, we can get access to care on day one, and two, Medicaid never ever starts on day one. Even if you have a prospect that has, $2,000 in the bank and that's it, and they're renting an apartment, and if they applied today for Medicaid, it's still going to take minimally 3 months for all the paperwork to go through. But chances are high this prospect still has a family that they love and the family that they want to avert from the physical toll of taking care of them. So the nice thing about that short-term care product is we can give them access to care on day one, and it gives a tool, because that's what we're doing. And Buddy continues to provide tools for you. What tools does this prospect need in the event that they need extended care? That family member can go get a tool out of the toolbox to get the home care until they can get placement into a facility and until they can get the Medicaid paperwork figured out. Okay. Now, with that, just because Rhonda said I could have a year doesn't mean we always have to offer the full year benefits, right? So if you do have a client or a prospect that really has minimum assets, maybe $50,000, we know in a matter of a couple months it's going to be gone for Medicaid. So we don't need to write the 360 days in that facility. You could even go down to, say, 6 months or maybe even 3 months of benefits to get them that care on day one. Maybe we get the home care, the facility care, and we know that they're not going to have a lot of assets, so it's not going to take long to spend down and qualify for Medicaid. So from a wealth perspective, for the people that you're dealing with that simply do not have the assets or the income to fund, even though their health may be good, they may qualify physically, cognitively for a traditional or hybrid product, but maybe financially, it's just not in the cards for them to have that product. So we have those features. So what's the downside is we don't have products in every state. However, at the end, we're going to bring Renee Caldwell in, and she's going to talk about Bankers, where we have a lot more accessibility with that product in multiple states. So we're going to keep Renee on the sidelines for us, and she's going to talk about Bankers when we're done here. Okay. All right. Before I move on to the health part of it, any questions on what I've shared so far?
I have one.
Hi, Sam.
Hi, Rhonda. So how does it work with the premiums? Are they guaranteed level when you get the policy, or can they increase?
It's going to depend on which contract. And I'm trying to remember, I want to say it might be GTL that they're 5-year age band. And Jason, if you know this answer, feel free to chime in. I want to say it's GTL that every year, 5 years, they reach that new age. So they do go up, but typically they are level premiums based on their age and their health. So they won't receive a new premium like Medicare every year. However, they're not guaranteed like a hybrid product where they're not guaranteed 100% to never ever change.
Yeah, I'll look at that. I think you
Okay.
might be right, Rhonda, but I'll double check that one.
And if
Thank you.
Ann or anybody else knows, feel free. I'm not the end all that knows everything, but happy to talk.
And then you just pay forever, like with regular long-term care
Yes.
until you go on claim?
Correct. And that's the other thing with the short-term care is there is no waiver of premium. So even though they are on claim receiving benefits, they still maintain those premiums for that 360 days of benefits.
So Rhonda, looking at their pricing table, it looks like you're definitely right that they have 5-year age bands. I'm not able to discern just from looking at it if it is new business rates or if
I
it
want to
is
say
in
because I
force.
had a client that it took me by surprise that they called me and had their premiums went up, and that's
Yeah.
so. Okay,
So you
Yep,
Oh,
go
I'm
ahead.
sorry. I'm sorry. So if you do go and claim, you still pay premium, but then once the benefits are exhausted, then I presume you stop paying at that point.
Correct.
Got it. Thanks. Okay. Sorry.
No, that's fine. Ask away. All right, so now let's talk about why would we offer short-term care for people that may have health issues. First of all, we have two products in particular we're going to talk about today that do not have height weight tables. How often, first thing we ask, I always ask, what's your date of birth? Do you use tobacco? And what's your approximate height and weight? Because and then we go right to the charts and say, okay, are we in? Are we class 1? Are we class 2? Or are we in no go? And unfortunately, it happens a lot. So the nice thing with that short-term care is we have no height weight question. I believe Aetna may ask the actual height weight question, but it does not disqualify you from actually applying or getting an actual policy. Romeo is shaking his head yes. So thank you, Romeo, for confirmation. Okay, so that is huge. The other thing is keep in mind they're on a short term, so they're going to pay a maximum of 360 days. Now, here's another thing too. We may say, you know what, I just want facility. I want 360 days facility, but maybe I'm widowed, I'm single. I know I'm not going to be home much. I'm going to want to go to the facility. Maybe you only want 3 months for home care, but you want the 360 days facility. Or maybe like I had somebody last week that they really want home care. They wanted 360 days for the home care, but maybe only 3 months for facility. So even though you can have a max, you do not have to be identical on those benefits. You can pick and choose as much as little as you want. So that goes back to our listening skills when we first talk to people as to why they inquired about long-term care, what is their concern, and if they're more concerned about home care or facility care, don't be afraid. We can adjust those quotes, illustrations to help fit whatever their needs are if it doesn't fit in the budget. Okay. The other thing is they are willing to take on people with a lot more health issues than they would a traditional or a hybrid product. So Romeo, Diana, anybody feel free to shout out. I'm thinking diabetics. They're going to be a lot more lenient on taking our diabetics. Now we're still going to have some basic knockout questions, particularly if we're going to go with the facility care. But typically all these short-term care plans, they also offer a standalone home care only. And those questions are even shorter. You may only have like 4 or 5 yes, no questions, where you may have 10 or 12 to get those facility benefits. So you can indeed just get home care only. You can do the combination where I say, well, I want 3 months facility and 1 year of home care, or 1 year home facility, 3 months home care, or 6 months each, whatever. But you could also say, just give me facility only, or just give me home care only. Just keep in mind, if we do home care only, you actually have a lot shorter list of questions. So I helped some gal last week. I'm trying to remember she was on disability. She's on short-term, I'm sorry, Social Security disability for under age 65. And that knocked her out of the facility benefits. But I was able to get her a 1 year of home care only policy because they did not ask that short-term disability question. Okay. So I always say, just go back to get your fact finding, get their health information. And then I just go to the carrier, look down the yes, no questions, see if I think they can answer no. Then on my second meeting, I bring it back up, say, okay, can you look at these questions? Can you answer no to these questions? And there we go. Then you're going to know. I don't think I maybe had one in my time, 1 or 2 maybe, that actually been declined, because typically if you can answer no to those basic questions, you're going to be guaranteed a policy. Now it's not guaranteed, but I will tell you typically that's how it works.
Yeah, and Rhonda, just a couple more underwriting notes to add. I know I'm speaking specifically for Aetna in this case. Doesn't mean it doesn't apply to other carriers. I know underwriting can tend to vary pretty wildly from carrier to carrier in short-term care. But for Aetna, you mentioned no height weight chart. You mentioned diabetics, they'll take less than 49 units of insulin. Um, for insulin-dependent diabetics, certain lung disorders, I guess if you take less than 3 medications for that disorder and no nebulizer or oxygen use, that's always kind of a, big deal. But certain lung disorders they can be really good for. But I think the one that most people don't know about is there are many prescriptions that are commonly uninsurable that Aetna may be able to consider if taken for what we would call off-label reasons. So I've had actually, when I was writing business, a couple of declines for clients who use Seroquel for sleep, and Seroquel is commonly used as an antipsychotic medication. So for many carriers, they will assume, just reading by the letter of the prescription, that there is some sort of cognitive indicators there that they might want to steer clear of, so that medication is typically uninsurable. But if you use it for off-label reasons, Seroquel for sleep is a common use, they may be able to actually consider that. So there's quite a number of medications that fall under that: Abilify, Aricept, um, prescription cannabis, insulin we talked about, um, you know, Risperdal, Prozac, Seroquel, those typical antipsychotic meds. They can have some wiggle room there as well. So just wanted to get that piece across, and we have a number of questions if you want me to
Okay, sure.
feed you them. Let's see. This one may just be a comment from Kristen. I personally have a traditional long-term care policy from Moo that I got about 15 years ago, 90 a limb, 3-year benefit period. Then I purchased a short-term care policy that has a 0-day a limb and 180-day benefit. Yep, so now I have day one coverage. Short-term care policies from Medico had it for 8 years, haven't had a rate increase yet. So that's really good personal perspective. And I think, short-term care as a gap filler is a really, really good idea. And Rhonda did a really good job kind of spelling out why that may be the case, for folks who already have coverage, seeing you through that 90-day limb. But for folks that can take advantage of partnership, even from a small traditional long-term care policy, like they may not have the income or cash assets, but they have assets like a home to protect, right? They can buy a small traditional policy, take advantage of the partnership, and see themselves through the elimination period with a short-term care plan, in that way. So
And
yeah.
I'd like to add something there to Jason and Kristen.
Mhm.
Kristen's on the right track there too. How many of us are getting phone calls that people have a Genworth, a John Hancock, a MetLife, or Prudential, a mutual companies that they've had plans around for 20 years, and they're getting rate increases. And now we're reviewing their policy. And at the time, 90-day elimination period, back then at, $3,000-4,000 a month, didn't seem too bad. But now when we're looking at, excuse me, three, $10,000-12,000 a month for 90 or for 3 months out of pocket. It's a lot bigger jump. So I had an appointment today where somebody's like, I bought this policy, it's $200 a day, but there's no inflation. I think we need more coverage because we're only in our early 70s. Same thing, they may be saying, hey, what are we going to do how can we cover that 90-day elimination period? So you might be able to go in and do, if they're in a state that has it, go in and offer a short-term care product to go in and fill that gap, because again, $12,000 out of pocket 20 years ago versus now you're looking at, maybe $30,000-40,000 out of pocket is a much bigger concern.
100%. Yeah. Lisa had a question. Can the pool from home care in these plans transfer to facility care in any way?
Well, it depends on if they have the facility part, but they will totally keep them separate. So if you have a home care policy only, you cannot transfer that to facility. It doesn't have an alternate plan of care that says I can go ahead and use it in facility. They're going to keep those two pools distinctly separate.
Yep. And Mary asks, if someone wants 12 months of facility and 3 months of home health care, does that technically make it a 15-month policy?
Well, it's one policy, but it's got two provisions in it. It's going to pay you the 360 days for facility, but you're going to get maybe 90 days for home care. So however you want to look at it, but they're going to truly keep it separate. So assuming they start out with home care first, they could use 90 days and then they go to facility and then they've got their 360 days. So yeah, that's 15 months, but there's no guarantee that they'll use all of one or the other. So
Right. Right. Um, so I think that's what we've got for questions. Yeah, Jackie kind of mirroring what Kristen said. That's what I did for my mom. She had a MetLife with a 100-day a limb. got a short-term care policy for her at age 82. Premiums back then were $74 per month. So appreciate everybody kind of sharing their experiences here. Wish we had this in California. Boy, don't I agree with you.
I do too. We all do.
So I shared a list in the chat that might be outdated. Well, it definitely is. It doesn't include Manhattan Life and Wallaby, two of the kind of relatively newer arrivals to the industry. But just to give you kind of some guidelines as to where short-term care products are available. Also, if you are in the buddy system, we speak to for specifically short-term care products, we speak to Aetna, Manhattan Life, and GTL. And I actually do have the state availability outlined there as well on these preview cards, so you can get an idea of where it's not available. Anywhere else, you can freely assume that these are available, and you can for GTL, you can just click inside to get those pieces of info. So this is where it is available.
Yeah, and those typically are my three favorite plans to work with. For longest time I had GTL because they had inflation and Aetna did not. But Aetna offered 360 days home care and 360 days facility where GTL's was only 6 months or something like that for home care. So I kind of switched gears to Aetna, but now we have Manhattan, yay. And Manhattan on their plan, they now have inflation. So number one, we can get $400 a day for facility. We will get 300 a max for home care, but they both can go for 360 days. And I love that because it's just a lot simpler than saying, well, with Aetna, you get, $300 a day for 360 days, but your home care, you're going to get $1,500 a week for 52 weeks. It just kind of keeps everything as simple as possible. So I like that with the Manhattan, and they have inflation, which is really important. I
Yeah.
don't even care if you're in your early 70s. So that's why I really kind of gravitate towards the Manhattan product now.
Yeah, one thing to add there to the inflation, I don't know if you were just about to get into this, if you were, sorry to cut you off, but to prevent kind of adverse selection, Manhattan Life's inflation protection is a 5% simple, but it has a 6-year vesting period. So once you hit that 6th year, your benefit will grow by 5% every year for 20 years until your daily benefit has essentially doubled in value. Still an amazing value given how high of a pool you're starting at, right?
Right. So basically, if you ask for starting out with $200 a day and they get their contract, it's actually going to be lower. It's going to take that 6th year before it's going to get to $200 a day.
Yep.
So that is good to know too. The other thing, what else was I going to say about Manhattan? No height weight question with Manhattan as well. That's huge. Oh, now if you get, what's interesting is if you get into Manhattan has a home care only plan, no facility. The downside on that, and that's where, again, that's where it gets fun, where you just get in the weeds and compare. Same thing like GTL has their home care only plan. They will say, maybe you get $450 or $500 a day maximum, but they actually break it down per category. So if you're getting like physical therapy, occupational speech therapy, we'll pay you a maximum of $150 a day for that category. Or if you need an LPN, we'll give you $150 a day. But you add your different categories up, the most you're going to get is $450. Well, what's the main reason why people purchase this? It's not so much for physical therapy. They're doing it for home care services. And typically they're paying a lower home care services, like $120 a day maximum. So that's where I like to gravitate towards Aetna's home care only. It is cash. I don't have to worry about different categories, and I can have all 360 days, still have a 0-day elimination period. May not get the inflation, but it's just going to be a lot smoother, easier, and here's your money to spend.
Yeah, 100%. And one of the things we're starting to see is restoration, especially with Manhattan Life's plan. So you can actually see a lifetime maximum of up to 2 times your benefit period but there is a stipulation that you must spend 180 days out of care in order to trigger that restoration. So it's not something that will be available to claims of all shapes and sizes, but if there is a case of, needing care, coming off of care and needing it again, that's some nice protection to be able to have in your back pocket as well.
And I think of strokes, MS, Parkinson's, typically people may need care for a period of time, then they may kind of go back in remission and then they come back, need care again. Typically people, the older we are when we start to need it, typically we don't bounce back and get better. So the reality of using the restoration, so I personally don't push the restoration, but I just let them
Right.
know, hey, by the way, the nice thing, after you kind of sold it, you just solidify it and say, by the way, this does have restoration, unless they had a family experience and they bring it up, then by all means, you can answer that question earlier, but just don't promise them the restoration because they have, like Jason said, they have to have been off of claim for 6 months, 180 days before it restores.
Yep. Let me...
As far as the sweet spots and ideal clients, again, I think most of them in general kind of have an age 40 mark, 45, age 40, 45 before you can apply for those short-term care. So we don't really want the too younger people, but again, I'm using this for people that may not have the income or assets to actually qualify for financially to qualify for a traditional or hybrid product, or maybe they have health issues that they don't qualify for a traditional or hybrid product. So that's typically where I use them. I'm not afraid when I get leads because we still have people in their late 70s, mid to late 70s that are coming in now going, oh crap, I don't have a plan and I still love our kids, right? And so, respectfully, not all of them are going to be able to afford that or be able to do a single lump sum premium and just take it out of their portfolio. So that's where a good situation where the short-term care may come into play for those people financially as well, or
Yeah, and
health-wise.
age ranges are typically higher than you see for other products, right? Like up to 89 in some cases. So, as long as they're healthy enough to qualify at the end of the day, we do get questions about folks who are over 80 and have failed to plan and understand that I may be out of time, but do you have anything for me? And if you're in a state that doesn't offer short-term care products, but you have clients that are out of state, you just got to remember this and keep it in your back pocket because it could really help you save a case someday. Any other notes you had, Rhonda? Oh, Romeo had a question of, did Aetna increase the home care portion to 1,500 a week? Thought it was
Yeah.
only that high for home standalone.
I think I recently quoted them and gave 1,500 a week, but
The home care is 1,500 and the recovery care is still 1,200 on the home. So the one that has the facility and the home limits it to 1,200 a week.
Yeah, perfect. Yeah, thank you for that clarification, Diane. Appreciate it. And Renee, I know you agreed to join to give us just a few minutes on Bankers, who is kind of emerging as a not short-term care that's kind of available in all 50 states, which is really intriguing. I know you've done a study group uh, specifically to the Bankers products, and we'll likely have you on again sometime in the near future. But if you want to just kind of give a quick intro into Bankers and how they kind of fit into this discussion.
Yeah, sure. They are emerging. They're like the number one selling
Yeah, they're already
long-term care
here.
products out there. I'll speak just to they have two products. They have a tax qualified partnership plan, but also short-term care. So I'll just talk about short-term care today, but they do have age range of 50 to 79. They're in all 50 states. So we've got New York, I've got California, I've got all of New England, I've got Florida. So because it's a captive company, you would have to, if you wanted to work with me, Buddy INS would pay out a commission to you. So Mark would be on the part of the app. It's a 1-year plan with a restoration of benefits, and it's a 12-month, not 6-month, 12 months of continuing to pay your premium. $300 a day 5% compounding or no inflation. So here we can get real big short fat policies in California. Yeah, big ones can grow. We've got elimination period of 15 and 30 days. So not the 0 like Aetna and the other carriers, but still pretty short, accessible benefits. Underwriting wise, they'll take like diabetics because, well, let me back up. They do a prescription check as their only underwriting. So you have to be honest on the e-app. There is a height weight chart. It's more generous than the traditional carriers, but you still, right? If you can't make that, you got to go find Aetna. Hopefully you have it in that state. Underwriting is just a prescription check in the e-app. So if there's meds that are fine, you're going to get through within a day or two and get an answer. So it's a pretty quick process. Now, sometimes if there is a med that is, like I just submitted somebody that has a COPD med, but it's she's got prescribed for asthma. So what we do is we submit it, we get a decline, resubmit it manually with the doctor's letter, and then within a few days they'll manually underwrite and give the approval. Things like diabetes, they'll take up to 100 units of insulin a day. They don't ask for A1C numbers. So can be pretty flexible. All the major diseases, of course, you can't get through, but so usually the systems, when it's working well and automated, it goes pretty quick. What else? Usually, if you were to work with me, I'd get the policy mailed to me, paper policy. They're still a bit old school in many ways. And then I would, send it to your client, but you would have policy schedule pages and be the main go-to person. And so what else do I need to share, Jason?
I don't think there's anything you need to share if you feel like you've shared
Well, what am I missing?
all that is helpful. I think you really covered it. I mean, really, my big three are always sweet spots, ideal clients, and notes on underwriting. So I think you pretty much covered it. And
there's something in the chat about meds 5 years ago. Yeah, they'll pull quite a history of meds. Actually, I just had a local guy pull, he was given a med for like opioid and alcohol coming off that. And you can see when it's prescribed on the Milliman script, and it was only filled once. He doesn't even remember taking it, but it generated a decline and I have to get the letter. So they'll see everything back, and a lot of like he forgot he even had it or even knew what it was for, right? So, and the doctor said it was to enhance depression meds or something. So they'll see it. So if there's something you can anticipate, it's easy to work around if necessary.
Yep. Yeah.
One question I see here from Jeff, can a client purchase both home care and recovery care? You can have two products with Aetna, but they're going to cap you at your maximum of whatever they offer. So for an example, if you have $300 a day with one product and they come out now with 400, you can't buy another product for 400. You can only buy another product for another 100. So they're still going to limit their liability by whatever the maximum is. So you could buy a recovery care maybe that had 3 months of home care, and then you buy another home care only, but they're going to max you at that 360 days or the dollar amount.
Perfect. Yeah, so appreciate you giving your piece for us, Renee. And like she said, Bankers, technically a captive product, but we have the resources to build that bridge to Renee if you have a client that may be a good fit for Bankers Life, if you're in a short-term care state and you have a short-term care type candidate. Definitely something to keep in your back pocket because Bankers gaining a lot of popularity, like a lot from industry data. So definitely a good one to look out for.
Even if you look at the more traditional one, they only go up to 2 years. So they do have their limitations, right? Because of the taking such a large pool of risk with health, they're not going to give somebody a 5-year plan. So it's service day elimination period. It's a daily benefit, not a monthly pooled. So they've made their concessions to take higher risk, but overall the system is pretty slick, and people, they don't want to go through the interview or the home visit and the full underwriting, but they still want partnership, tax qualified plan. You can still get that in 50 states also without the rigmarole of. So the underwriting for the short-term care is the same underwriting for their long-term care product.
So Renee, on their short-term 1-year plan, if you build a really deep pool and you put that 5% compound, not that we anticipate it happening, but let's say they needed home care and they have, $12,000 a month for facility benefit or monthly benefit. Well, it'd be $400 a day for a daily benefit, but maybe their expenses were 300. Is Bankers going to be a reimbursement? Are they going to pay cash? And if they don't use it all up, will they continue to pay it off just like a traditional product?
Right, it's reimbursement. And so not the cash like Aetna, but it's like the total lifetime benefit. You only take what you need out of it. So the care could go beyond a year on the short-term care. And then also the restoration. So you can get a little bit more time if there's some freak accident, but you pay in a year, you recover, you get a whole other year later. So
that's a real sweet spot for, in my opinion, for Bankers with their 5% compound, because their 5% compound is so attractive premium wise. That's a way to help build up a robust benefit. And if they don't use it all, it can spread out, make it last longer for those people that are worried 1 year is not enough.
Yeah, I mean, 309,000 a month at 5% compounding in California is huge coverage. So yeah,
Agreed.
guess that's it, unless there's any questions.
Appreciate it. Diane, I saw you came off mute. Did you have something you wanted to ask or ask?
Yeah, just a couple things from my experience to add. One is I wrote a Manhattan Life, and they countered it and limited her to $100 a day because of a health thing. I didn't know that the short term did that, but Manhattan did that because of her health. So then we went and we got Aetna for the other amount of money she was looking for. So she still has what she wanted,
Oh, that's cool.
but I didn't know that Manhattan has a secondary level of benefits where they can limit what they're offering. So that's important to know.
Yeah.
I don't remember what the thing was that she had, but it limited it. And then the other thing, two things. I had to get up and walk out for a second. So I don't know if Rhonda, you mentioned that there is not a requirement for a 90 days for the short term to be used. So you can use it for 3 weeks after a hospital visit if you want to. I don't know if you brought that up. So
I didn't, so go
okay.
ahead.
Yeah, so you don't have to need for 90 days, which kind of makes the restoration of benefits a little more attractive, because what if you need it for 3 or 4 weeks after surgery? You can use it and then you get better for 6 months and boom, it restores back to what it was. So there's
Super
where
good
that
point.
can fall in and be a better situation. And then the thing that gets people all the time is, and I don't know the Bankers, but on the Manhattan Life and the Aetna, there's that one question that gets people. Do you have any procedures pending or test results pending or something that's scheduled that not done yet? Don't submit the application until they can say no to that question, because that's the one that gets the most people.
Bankers is the same, Diane. Anything pending, testing, procedures you haven't done yet, of course, any kind of disability. Same there. The one thing that Bankers is awesome at is they don't care if you're in physical therapy. They don't ask. So I don't know that Aetna and Manhattan are asking, but usually when there's some kind of treatment, right, you can't be applying. But Bankers, it doesn't matter.
Yeah.
But yeah,
I think all that info is super, super valuable because Rhonda, you mentioned it kind of at the beginning of the call, but I sound like a broken record sometimes when we have sessions like this around short-term care or alternative products, whatever it may be, is we're getting closer and closer to situations, Equitrust Bridge, right, where we won't have to say, sorry, I just don't have anything for you to someone. Now, they may be limited in financial means to accessing a product their health could buy them when they're, you know, typically lacking options to that end. But it's just knowing these little tidbits, right? Like understanding that there's no 90-day requirement for the short-term care, understanding where all of these carriers kind of fit in, what conditions they'll take, right? It's one of those things that you have to kind of file it away. Bankers, if they're currently on physical therapy, I think just filing these little nuggets away really help you to take advantage of what I'm saying there. That unless they're kind of limited financially, there is generally a nook and cranny we can find for somebody given their health.
I want to say all the short-term care plans have restoration. I know Aetna, GTL, Medico, I think they all offer that. And it's not that they offer it, it's included. It's a feature, it's not an option.
Mm-hmm.
And that's
Suzanne, do you
why
have a
they
question?
call them
I do,
recover
thanks.
care, recover cash, like to Diane's point, you can use it for short term. It doesn't have the IRS, tax qualified definition of minimally 90 days. That's why they're calling them recover care, recover cash, things like that. Because how many times do you have somebody that's in a hospital, has a stroke, and they go to a rehab, skilled rehab, Medicare is done after 20 days, and the family's like, I can't bring them home. And that's, where this comes in real value, peace of mind for family members to give them that extra therapy for another 2-3 weeks or months until they feel like they can come home.
You just brought up the IRS, so I've got a question. I've got $12,000 a month coming in from Aetna. My ELF costs me $6,000 a month or $7,000 a month. Is the rest of it going to be taxable?
I don't. Well,
It has to be under the per diem.
They'll say their reimbursement policies.
No, they're not reimbursement. It's indemnity. It's indemnity.
Aetna's indemnity.
It's the per diem. So right now the per diem is 12,400. So if you're getting less than 12,400, nobody's going to ask you about it.
Good enough.
But it's not a tax qualified policy.
But there's still per diem rules.
And they apply to non-tax qualified policies too?
I'm almost certain.
I don't know.
Almost.
I'm almost certain.
Just wondering.
That's a good one to take back.
Yeah. Good question, Romeo. I'm going to guess. Here's the deal, Romeo. I mean, it's a valid question, and I'm now curious about that. But the reality is that they have, say, $15,000 of expenses. It probably the amount of extra that they would have to report as income probably going to be a wash with all their medical expense. But it's still a valid question, and we should know the answer.
Suzanne, you've waited very patiently.
Oh, thank you. So for the short-term care, is physical therapy is an issue for that, but just not for bankers? Is that what we're saying?
Typically with short-term care, if you are currently being seen, treated, and you have not been released from care, don't apply, just like any other traditional product. I think Renee can speak on her own here, but
yeah, Bankers doesn't ask. It's the testing, any procedures, but it doesn't ask if you're currently receiving any treatment, right? You need to go get those testing results or get the procedure done. It doesn't say, are you in process? It's literally their knockout questions. It's black and white, and they don't answer. They don't ask. You say no, then.
Okay, got it.
You can't say yes.
And how about Crohn's for both short-term and bankers? Any thoughts?
I think lupus is the only autoimmune issue with bankers, because Crohn's is kind of an autoimmune digestive, right? Let me go hop into my thing here real quick.
Got it. Because I've got someone who's in physical therapy, but it's sort of it's almost like you would go to a trainer in the sense of like more for like to avert back pain, but it's not like there's an injury, and so it's not like someone broke their hip and then they went to physical therapy. It's more like an ongoing thing to keep pain away. So I don't know if that makes a difference versus your typical physical therapy where it's just for a short time and then you're done and dismissed. But
they don't ask. Jason, can I show the underwriting knockouts?
Yeah.
Let me share. Okay. So here's the questions. Let me get everybody out of the way here. The medical questions like confined to a hospital, anybody like power of attorney over you, can you do your
Uh-huh.
ADLs? Do you need assistance? Catheter, oxygen, dialysis. They recommended you be in a facility, then here's the three, right? Anybody recommended surgery that hasn't been performed, testing that hasn't been completed, or you haven't received results. And then we've got disability here.
Got it.
And then we've got, here's the list of diagnoses. There's no Crohn's disease. The
Okay.
things related to diabetes are basically all the, neuropathy, how much
Mhm.
insulin are you taking, ulcers, kidney problems, cancer. So you can have cancer. I have a guy that they're doing watchful waiting. He had prostate cancer diagnosed like 10 years ago, but he hasn't received any treatment. So it's like in the last 3 years, diagnosed or treated. It was over 10 years ago and they're not doing for it, so he can apply.
Hmm.
Um, yeah, so there's lupus, but there's no other digestive issues.
Got it.
So yeah.
And Rhonda, what do you think for the short term
Uh,
for
Um,
Crohn's?
I just look at the yes, no questions. That's what I do.
Yeah,
Uh-huh.
yeah,
I just
that's
always put in
probably
every
the best way
application.
to
Some of
underwrite
them
for
have like
those.
24 months, some have 36 months. So I just kind of go back to the applications and look at them.
Got it. Okay, thank you.
Yeah, yeah, I would always just review the actual applications knockout questions and treat them literally. If you can answer no to the literal way that the questions are asked, that is your ticket to apply at the end of the day.
Got it.
And I did
Thank
put a
you.
passage in the chat because I asked AI Advisor about Crohn's, and
No,
it'll
thanks.
give you at least a starting point.
Thank
Um,
you.
but hopefully that helps.
It does. Thank you.
And then I wanted to just quickly um share. You have a question, DW?
Do because I've got a background in some supplemental insurance, and so Romeo's question. So I looked it up, and according to Intuit, they do, a lot of tax stuff. They're saying it depends. So if you're getting an indemnity that's above your per diem and above any advance, so I can either read it to you or I can direct you guys to go check it out. But basically, they're saying, because this lady's saying, my parents had two LTC policies and they pay 130% of the per diem every day. And so they're saying you got to do a form 8853 and it will tell you how much of that is taxable. So hopefully that helps.
Helpful.
Thank you.
Sure.
Appreciate that. And I just wanted to share quickly because somebody had asked me about a summary for short-term care. And if you are a Buddy System member, I can always share this with the recording in case you are not. But in our individual product buddy, we do have short-term care plans. So basis of this tool, product recommendation engine, plug in some information about your clients and get an idea if your client, what may be some good solutions for your client based on the inputs you put in. But we do have short-term care products here. So if you select that, you'll get a PDF that you can use to leave behind with your client to say, remember, we talked through short-term care products. Here are some things to really remember about this plan, right? So it'll kind of give you ideal candidates. So age ranges, preferred funding, level of retirement, readiness, financial status, things of that nature. But it'll also give you kind of the whys that we've gone through, right? Pretty dollar efficient coverage. We talked about the simplified underwriting. We talked about higher benefit access, being able to access up to $400 a day, affordable premiums. We talked about the restoration and inflation growth on some of the plans, right? So even if you feel like you just need a refresher on the concept of short-term care for yourself, that's available in there. But for clients, especially if you have these sort of conversations, you might need to kind of give them a leave behind to refer back to, right? At the end of the day. So that, even if you're not able to meet again for a month, 2 months, 18 months or whatever it may be, right? They'll at least have that piece of paper that they can go back to and say, hey, what did Rhonda and I talk about, all that time ago? I'm ready to have that conversation again, so I want to refresh myself so we can kind of pick up where we left off. So just wanted to show that. Anybody else have any other questions, comments? Yeah, go ahead, Diane.
Jason, I want to address Jeff's question about the claims. He said they seem too good to be true. Are they going to underwrite on the back end? Who has experience? So the only experience I have with claims right now is with Aetna. I have two clients that used Aetna. One worked out easily and beautifully. It was wonderful. The other one, they're having trouble because one of the rules with Aetna is you have to have a professional home care visit at least 3 days a week. And then all the other money can be used for whatever you want. And that's what I tell the clients is that's just because Aetna wants to make sure that Johnny's not leaving mom on the couch and taking off with the money. But this one family, the daughter keeps sending in the claims, but she doesn't understand, and the home care agency doesn't understand that the assessment, the nurse coming out doing the assessment, or the person coming out clarifying what the prescriptions are that are being taken is not considered care. It's actually when somebody's going to give care is what counts as one of those 3 days. So they keep submitting like 5 days a week of stuff, but it's really only 2 days of actual care because there's people coming in, popping in and out for other stuff. So you got to be really careful to tell these people that with Aetna, you need some kind of professional caregiving, whether it be physical therapy or helping them get dressed or taking them to the, whatever. You got to have 3 days of professional, and it could be as short as 1 hour a day, but it has to be three separate visits. And this family is running into trouble because she thinks she has stuff for all these days, but really when it gets reviewed, it's only 2 days of care. So that week doesn't count. So you got to be
So you
really
would
careful.
characterize that more as a misunderstanding
Yes.
of how they activate the policy rather than a company bending over
Right.
backwards to deny a
Right. And so
claim.
I always want to make sure my clients understand how the 3 days of care means 3 days of care. And they're going to forget, right? And 10 years later, they're going to start using this stuff and you got to remind them again.
Yeah. And Jeff, just to your question as well, I think most carriers, if they have the ability to do this, would probably rather ask for a rate increase on in-force business rather than underwrite on the back end and bend over backwards to deny claims, just thinking from an optics perspective, right? Their reputation is staked on keeping their promises and being able to pay their claims when all is said and done. Um, you know, I think this is a type of plan that everybody has to realize is not immune to rate increases, right? The plans are not guaranteed level. They're designed to remain level. But at the end of the day, there is also a limit on the total exposure, right? Which does give the carrier a definitive point in time where they will be off the hook for each client's coverage. So there is a level of predictability there. And even with inflation protection on, say, like Manhattan Life's plan, the inflation protection is simple, not compound, and it is period certain. It is a max of doubling of your benefit. So there are mechanisms in place to specifically limit the carrier's exposure, but especially just the amount of benefit period. So much longer claims, much more catastrophic claims in nature, they won't have to see it through to the very end in those cases. So that's also part of what comes into being able to offer affordable premiums and feel a little bit more confidence into the future that they'll be able to kind of keep these plans level. And if not, they have the ability to ask for a rate increase at the end of the day. So
But they
that's
haven't.
just, and they haven't at this point. So that's just my point of view. It's not a crystal ball into the future telling you what to expect. These plans do get handsomer and handsomer as more carriers enter the space and try to compete with each other and one up each other. We saw that when Manhattan Life entered. I know Aetna is certainly thinking about those moves made by Manhattan Life and trying to beef up what they're doing as well because they were largely the incumbent carrier here. And, the entrance of bankers and the way they work as far as short-term care plans, who knows what that will cause some of the other carriers to, really do or adjust in this case. But it is a market that is pretty darn competitive and has a really interesting future ahead of it and a lot, just a Swiss Army knife in some of the ways it can fit into a plan, right? A holistic plan, right? Being able to be stacked, being able to be kind of a gap filler, underwriting, affordability. There's a lot to like about these plans, but I agree. Sometimes these plans do sound too good to be true at the end of the day because there's so much that it offers, but it also takes specialists like Rhonda, Renee, Diane to kind of understand those sweet spots and where to actually apply it at the end of the day. Hey, you are very welcome. Anybody else have anything they want to add before we wrap it? I really appreciate everybody's kind of contributions, sharing their experience. Rhonda, Renee, Diane really helping guide some of the conversation here. Last call before I set you all free. Awesome. Well, this was a great discussion. I'll try to put more of these together for other product types so we can kind of just review them on their own, standalone. And if you have any requests, if you know any people who are killing it out there in a certain area and you want to see them present and show their stuff as well, I'm always taking recommendations. And that's it for this week. So appreciate you being here. Be well, and we will talk to you this time next week. Have a good one, everybody. Thanks again, ladies and everyone.